For 17 years, Bernie Madoff ran the largest Ponzi scheme in history, stealing $65 billion from unsuspecting investors. Thousands of people lost their life savings, their retirements, and their dreams. Yet somehow, nobody stopped him. In the 1960s, Bernie Madoff founded a legitimate investment firm in New York. He started small but quickly built a reputation as a brilliant and trustworthy money manager. His strategy seemed simple. He'd invest clients' money and deliver steady returns. What made Madoff different was his exclusive aura. He didn't advertise or chase new clients aggressively. Instead, he created a feeling of privilege, as if investing with him was an honor you had to earn. Wealthy individuals, celebrity families, and charities all wanted to give Madoff their money. They believed they were accessing a secret money-making machine. The promise? Consistent returns, regardless of market conditions. But here's the problem. Markets don't work that way. Some years are up, some are down. No legitimate manager delivers the same gains every single quarter. Yet Madoff did, year after year. This was the first red flag that should have triggered investigations. The Securities and Exchange Commission, the SEC, is supposed to catch this. But they didn't. Why? Because Madoff had something most fraudsters don't: credibility and connections. Madoff served on the board of NASDAQ and was a respected elder statesman of Wall Street. Regulators treated him with deference rather than skepticism. The people supposed to police him actually trusted him. Between 2000 and 2008, multiple people warned the SEC about Madoff. One whistleblower, Harry Markopoulos, sent investigators a detailed email explaining exactly how the scheme worked. The SEC investigated and found nothing wrong. Why didn't they listen? The SEC was underfunded, understaffed, and overconfident. They didn't understand the mathematics of his strategy. They saw his reputation and closed the case. There's another reason nobody stopped Madoff: the auditors. His firm used a tiny one-man accounting firm that basically rubber-stamped his books without real scrutiny. No independent verification ever happened. The auditor didn't verify where the assets actually were. Nobody called the banks. Nobody confirmed the stock trades. The entire paper trail was fabricated, yet it looked legitimate on paper. Madoff also exploited human psychology. Investors wanted to believe his story because it made them feel special. Admitting they were fooled felt worse than accepting the narrative he sold them. When you're making money, questioning it feels rude. Madoff's wealth created a halo effect. Rich, successful people wanted his attention, and they weren't going to ruin it by asking hard questions. Madoff also kept his strategy intentionally vague. When clients asked how he made money, he'd talk about split-strike conversions, a real but obscure trading technique. It sounded sophisticated enough that few dared push back. He also used something called feeder funds, intermediaries who collected money from investors and funneled it to Madoff. These middlemen took cuts and rarely questioned what was happening. They had too much to gain by staying quiet. For decades, Madoff also benefited from a culture of deference on Wall Street. Nobody wanted to accuse a respected figure of fraud. The social cost of being wrong was too high. The banks that held Madoff's client money also had no incentive to dig deeper. They collected fees on every transaction. Madoff's scheme was profitable for them too. In 2008, the financial crisis hit. Markets crashed, people panicked, and suddenly everyone wanted their money back at once. That's when the scheme collapsed completely. Madoff couldn't generate fake returns fast enough. When he finally confessed to his sons, they called the FBI. On December 11, 2008, Madoff was arrested at his apartment. 17 years, $65 billion stolen, thousands of lives ruined, and the system designed to catch him had failed completely. The SEC later admitted it should have caught him. A government report identified multiple investigative failures. But by then, the damage was done. Madoff was sentenced to 150 years in prison at age 70. He died behind bars in 2021, never serving a day of freedom after his arrest. But the real lesson isn't about Madoff alone. It's about the systems that failed. The SEC, the auditors, the banks, and the culture of deference all made the fraud possible. Red flags were everywhere, consistent returns that defied math, an auditor with one employee, vague strategies, silence from whistleblowers. Yet everyone ignored them. This case changed how Wall Street is regulated. New rules require better auditing, stronger whistleblower protections, and more skepticism of extraordinary claims. But reform only came after billions were lost. The Madoff scandal teaches us that trust without verification is dangerous, that systems matter more than individuals, and that oversight only works when people actually use it. Nobody stopped Bernie Madoff for 17 years because everyone in the system failed to do their job. That's the real story behind history's biggest financial fraud.